Acretrader functions as a specialized crowdfunding platform that utilizes a fractional ownership model to bridge the gap between individual investors and physical farmland. The core mechanics involves the platform purchasing a specific farm, placing that property into a unique limited liability company, and then selling shares of that company to participants. This creates a distinct investment vehicle where the primary goal is to provide a hedge against market volatility through an asset class that has historically shown low correlation to the traditional stock market. The platform acts as a rigorous filter for quality, claiming to review thousands of parcels while selecting only about 1% of those properties to actually list for its users. This meticulous selection process is paired with a high level of transparency, as each offering includes exhaustive data regarding soil maps, water rights, local commodity trends, and historical yield performance. For those seeking a hands-off experience, the system is designed to be fully passive. The platform manages the heavy lifting, including lease negotiations with farmers, handling insurance, managing tax documentation such as K-1s, and overseeing general farm management. From an investment perspective, there are two primary revenue streams to consider. The first is derived from annual cash rents paid by the farmers, which acts as a form of passive income for shareholders. The second comes from land appreciation, which represents the capital gains realized when the farm is eventually sold at the end of its hold period. However, prospective participants must navigate several significant barriers. The most prominent is the accreditation requirement. Most offerings are restricted to accredited investors, meaning individuals must have a net worth exceeding $1 million or an annual income over $200,000. This naturally excludes a large portion of retail investors. Additionally, the capital requirements are substantial, with initial minimum investments typically ranging from $15,000 to $40,000. This is a high entry point for a single asset, especially when considering the extreme illiquidity involved. Unlike a typical stock or real estate investment trust, there is no active secondary market, and the expected hold period spans 5 to 10 years. During this time, accessing the principal is essentially impossible. The fee structure also impacts overall returns, as investors usually pay an annual management fee of approximately 0.75% of the asset value, and the platform takes a flat fee of about 5% from the final sale price of the land. When shifting focus to the farm owners and operators, the platform acts as an alternative to traditional bank financing by providing equity capital rather than debt. This is particularly beneficial for farmers who want to expand their acreage without the burden of high-interest loans or massive debt. It serves as a flexible tool for various career stages, helping older farmers transition out of land ownership or allowing younger farmers to scale their operations through long-term leases. One of the strongest advantages for operators is the access to capital for improvements. The platform often funds value-add projects, such as the installation of new irrigation systems or tile drainage, which can significantly increase the productivity and efficiency of the farming operation. Farmers also have the option of a leaseback agreement, where they can sell a portion of their land to unlock liquidity while continuing to work the same soil as a tenant. However, these benefits for the farmer come with clear trade-offs. By selling to an investor-backed model, the farmer forfeits future appreciation of the land. Any long-term rise in the value of the acreage goes to the investors rather than the person working the land. There is also a shift in the power dynamic, as the farmer becomes a tenant dependent on a lease. If performance standards are not met or if a lease is not renewed, the operator could lose access to the property entirely. Furthermore, the standards for partnership are quite high, as the platform tends to work only with best-in-class operators, meaning smaller or struggling farms are unlikely to qualify for this specific type of equity partnership. Acretrader represents a sophisticated tool for diversifying a portfolio into hard assets that produce food, making it an attractive inflation hedge for those with a 10-year time horizon. It solves the pain point of finding stable, non-correlated assets, but it is not a solution for those needing liquidity or those with less than $20,000 to commit. For the farm owner, it solves the problem of needing capital for expansion or succession planning without traditional debt, provided they are comfortable with an investor landlord and the loss of future appreciation. The risks remain centered on the long-term illiquidity for the investor and the loss of autonomy and future gains for the farmer. Success on this platform requires a deep understanding of the 5 to 10-year commitment and the specific fee structures that will impact the final bottom line. It is a powerful tool for a specific type of user, but the high entry barriers and the lack of a secondary market are the most critical factors to weigh before participating. In summary, this platform offers a unique way to access the stability of farmland, providing a double revenue stream from rents and land value increases while remaining entirely passive. However, it is essential to reiterate the risks involved, specifically the extreme illiquidity and the lack of a secondary market for shares. Investors must be prepared to have their capital locked away for a decade. For farmers, the primary risk is the transition from owner to tenant and the loss of all future land appreciation. While the selection process is rigorous, the high minimum investments and the requirement for accredited status make this a tool designed primarily for high net worth individuals and top-tier farm operators.